Welcome to our deep dive on the hidden value of negative cash flow and whether you should rent your home for less than your mortgage payment. First, we will frame the scenario many owners face after a sudden relocation or job change. Then, we will show how small monthly deficits can still build long-term wealth through equity. And we will compare renting versus selling in today's market. Finally, we will share practical steps, examples, and strategies to help you decide rationally. Here is our agenda. First, we set the context. Next, we explain the equity advantage even with a cash flow gap. Then, we calculate the true cost and show you how to stress test your numbers. After that, we cover strategies such as refinancing, midterm rentals, and tax benefits. We will then walk through a decision framework, answer 2 quizzes, and wrap with key takeaways. Before we proceed, a quick disclaimer. This content is for education only and is not financial, legal, or tax advice. Your situation is unique, so consult qualified professionals regarding your specific property, financing, taxes, and local regulations. With that said, let's smoothly transition to the core scenario. In this scenario, you bought recently and now must relocate, but market rents don't fully cover your mortgage, taxes, and insurance. Instead of rushing to sell into a soft market and absorbing immediate selling costs and potential price declines, consider renting. Even if there's a small monthly deficit, you may be converting a near-term expense into long-term equity growth, especially on shorter amortization schedules. Now let's define that equity advantage. The core idea is that if rent covers most of your interest, taxes, and operating costs, then your monthly out-of-pocket often funds principal paydown. That paydown is equity you keep. On shorter-term loans, such as a 15-year mortgage, principal amortizes quickly, which accelerates equity building. To stay objective, ask, would I buy this house today purely as a rental at the calculated loss? If the equity growth, potential appreciation, and tax benefits justify it, then the temporary shortfall can be rational. Next, let's quantify the true cost beyond the mortgage payment. This pie chart visualizes a typical monthly distribution. The largest share is mortgage interest, followed by property taxes, then insurance. We also reserve portions for maintenance, management, and vacancy. Finally, a meaningful slice is principal, which becomes equity. The key insight is that while cash is going out, a portion is transforming into owner equity. Now, to make this practical, we will calculate your true monthly cost step by step. To calculate the true cost, begin with your gross rent. Subtract a vacancy reserve between 5 and 10%. Next, subtract management fees if you will not self-manage. Add a maintenance reserve calculated as roughly 1 to 2% of property value per year divided by 12. Include your full PITI. Then, compute net cash flow by subtracting all expenses from the net rent collected. Identify how much of PITI is principal to estimate monthly equity gain. Consider tax impacts such as deductibility of interest, taxes, maintenance, and depreciation against rental income. Finally, stress test your plan by asking whether you can handle a prolonged vacancy or an unexpected major repair. With that framework, let's see a concrete example. This illustrative table shows a situation where the gross rent is $2,200. After a 5% vacancy reserve, net rent collected is $2,090. PITI is $2,300. We budget $250 for maintenance and $0 for management since we are self-managing. Net cash flow is negative $460. However, approximately $650 of the mortgage payment is principal, which increases equity. Therefore, the combined economic effect is roughly positive $190 per month before taxes. Your numbers will vary, but this illustrates how a cash deficit can still create net wealth. Next, we will compare holding and renting to selling now. Selling now provides immediate liquidity and avoids the responsibilities of landlording, but it likely realizes selling costs of 6 to 8% and locks in today's market price. Holding and renting preserves upside from appreciation and ongoing principal paydown while potentially providing tax benefits. However, holding requires adequate reserves and risk management to handle deficits, vacancies, and repairs. With that trade-off in mind, let's formalize a decision framework. This flowchart begins with a relocation event and asks whether rent is below your mortgage. If it is not, then renting out with positive cash flow is straightforward. If it is, you compute the true total cost, including vacancy, maintenance, management, and PITI. The next key decision is whether you have at least 6 months of reserves, plus a buffer for a major repair. Without reserves, consider selling or house hacking. With reserves, hold and rent, while exploring strategies such as midterm rentals and refinancing when rates drop. Finally, review the plan annually, updating rents, taxes, and capital expenditure forecasts. Now let's maximize income and reduce risk. To improve outcomes, consider refinancing if interest rates decline, possibly to a longer term to reduce the monthly payment and increase flexibility. Explore alternative rental models, such as midterm furnished rentals for traveling professionals or corporate housing. These often command higher rents. Work with a tax professional to leverage deductions for interest, property taxes, maintenance, and depreciation. Maintain robust reserves and ensure your landlord insurance adequately covers liability and potential loss of rent where applicable. Operationally, screen tenants carefully, perform preventive maintenance, and reassess rents annually. Next, let's visualize how a multi-year plan can evolve. This timeline shows a reasonable 5-year evolution. In year 0, you purchase and must relocate unexpectedly. In year 1, you rent at a slight deficit while building equity through principal paydown. In year 2, you transition to a midterm rental to narrow the gap. By year 3, you refinance to a lower rate or longer term, bringing cash flow closer to or above break-even. In year 4, rising rents, stabilized operations, and funded capital expenditures strengthen the asset. By year 5, you have optionality to move back, sell into a stronger market, or keep the home as a stabilized rental. Now, let's test your understanding with quick quizzes. Quiz time. The question is, which costs should you include beyond PITI when evaluating a rental with a potential monthly deficit? The options are only maintenance, vacancy and management fees, only depreciation, or only HOA dues. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is maintenance, vacancy, and management fees. These recurring costs are essential to include in a realistic underwriting because they often expand what looks like a small gap into the true monthly deficit. Our second question is, when might it be rational to accept negative cash flow and hold the property? The options are when you have no reserves and the deficit is large, when rent covers most interest, taxes, and operating costs, while you can safely fund a small deficit and principal paydown builds equity, when you want immediate liquidity regardless of selling costs, or only when you plan to move back within 1 year. You may pause the video now to consider the answer. We will reveal it in the next section. The correct answer is when rent covers most interest, taxes, and operating costs, you can safely fund a small deficit, and principal paydown builds equity. This makes the trade-off rational as long as you have sufficient reserves and a plan to improve cash flow over time. Key takeaways. Small monthly deficits may still build wealth through principal paydown. Always include vacancy, management, and maintenance in your analysis. Consider refinancing, midterm rentals, and tax benefits to improve cash flow. Only hold if you maintain strong reserves and have a clear plan. Finally, evaluate your choice against selling costs and current market conditions in an objective way. Here is a quick Markdown style cheat sheet you can apply to your own numbers. The formulas outline net rent collected, net cash flow, and an economic net that adds principal paydown. The tip is to rerun sensitivities on vacancy, rent, and maintenance. The goal is to ask whether you would still purchase this asset at the calculated loss. If the answer is yes, holding can be rational. Next, let's summarize and close. In summary, negative cash flow can be strategic if it buys you equity and time while you improve operations. Always underwrite using vacancy, maintenance, management, PITI, and tax considerations. Improve results with midterm rentals, refinancing, and disciplined reserves. Decide with a framework, not fear. Finally, let's close with a quick thank you and a creative call to action. Thank you for watching. If this was helpful, please like the video, share it with someone facing a similar decision, and subscribe for more practical real estate breakdowns. What is your plan? Sell now or hold and rent? Share your strategy and questions in the comments so we can discuss together.